So I'm sure you've heard all the talk about the death of the office, right? But let me tell you, that is barely half the story. There is a much, much bigger and kind of invisible shift happening in the world of real estate right now. And over the next 2 years, we are about to witness one of the biggest wealth transfers in modern history, not from one person to another, but from one type of building to another. All right, let's dive in and figure out who the new landlords of 2026 are really going to be.
For most of us, this is what real estate investing looks like. A REIT, a real estate investment trust. You buy a share just like a stock and boom, you're a landlord, you're collecting rent from skyscrapers and shopping malls, and you never have to deal with the leaky faucet. I mean, the whole idea is that it's supposed to be simple, diversified, and totally accessible. Seems like the safest, easiest way to own a piece of the physical world.
But here's the real kicker. The question we have to ask is this. As we're barreling towards 2026, what is actually hiding inside that simple, safe-looking investment? And I'm going to be blunt here. Many of these portfolios are loaded with what are essentially becoming zombie assets, buildings that are liabilities in disguise, and they are quietly bleeding value right under our noses.
So where does this all start? Well, it starts with a ticking clock, a massive financial pressure cooker that is forcing this entire change. And look, this isn't some wild speculation. This is just cold, hard math with a deadline that you absolutely cannot move.
All right, here is the number that is literally giving property owners nightmares. $1.8 trillion. This is what the industry calls the wall of maturity. It's this colossal mountain of commercial real estate debt that was taken out years ago, and it is all coming due right now between today and 2026. Every single one of those $1 trillion has to be paid back or refinanced.
Okay, so here's why that number is so terrifying. They borrowed that $1.8 trillion back when money was basically free, when interest rates were near zero. Now they have to walk back into the bank and get a new loan in today's world, where money is expensive. This creates a huge financing gap. And for a whole lot of property owners, that gap is it's a chasm they can't cross. There's no way.
But here's what's really fascinating. This pressure, it's not like some tidal wave that's just wiping everything out equally. No. Instead, what's happening is this pressure is acting like a giant sorting hat for the entire real estate world, creating this historic split between winners and losers. This is what we're calling the Great Bifurcation.
So on one path, you've got the relics of the past, right? The half-empty office towers downtown, the big, fancy global headquarters. These are the properties that are struggling with huge vacancies and falling rents. But on the other path, you have the essential infrastructure of our new economy, the local fulfillment centers that make e-commerce work, and the massive data centers that are literally the physical backbone of the AI revolution. It's a tale of two completely different markets. One is sinking fast, while the other is just taking off like a rocket.
Okay, so to really get our heads around the losing side of this split, we need to do a bit of an autopsy. And there's no better case study for the anatomy of an office zombie than the spectacular rise and fall of WeWork.
Just look at this timeline. It is absolutely mind-blowing. Back in 2019, WeWork was valued at $47 billion. Then, poof, the IPO completely fell apart. A couple years later, it limps to the public market at just $9 billion. That's an 80% loss right there. And then by late 2023, it was all over. Chapter 11 bankruptcy. How on earth does a company lose that much value that fast?
Look, WeWork was the poster child for a broken business model that was just supercharged with cheap money. They were using the Silicon Valley blitz-scaling playbook. Just grow, 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 and we'll figure out how to make money later. But the fatal flaw was baked right in. Their costs were long-term. They were signing these 15-year leases on huge office buildings. But their income was short-term, selling flexible month-to-month memberships. The second the economy changed and work from home became a real thing, that massive mismatch just blew up in their face.
And this is where it gets really important, because WeWork wasn't just some isolated screw-up. It was a symptom of a much, much bigger disease. Even before WeWork went under, nearly 18% of all office space in the US was already sitting empty. So when one of the biggest tenants in the world suddenly tries to ditch hundreds of leases, it's like pouring gasoline on a fire that's already raging out of control.
All right, enough about the zombies. Let's flip the script. Let's talk about the other side of this bifurcation, the side that's not just surviving, but is absolutely booming. Because while the office sector is crumbling, two new pillars of real estate are rising up, and they're stronger than ever. First up, logistics. We all think of e-commerce as this digital, cloud-based thing, but it runs on a massive physical foundation. A giant like Amazon doesn't just exist online, it needs millions and millions of square feet of warehouses and last-mile delivery hubs to get that package to your door. And as companies are shifting to more local, resilient supply chains, the demand for this kind of essential infrastructure right in our own backyards is just exploding.
And the second pillar? Well, it makes logistics look like a warm-up act. We're talking about data. The insane speed of the AI revolution is what you're seeing here. Global spending on AI is set to just skyrocket, growing 36% a year. But this isn't just about clever software. It's about the very real, very physical hardware needed to power it all. And all that computing, all that data, it has to live somewhere.
And where does it live? In these gigantic, power-hungry buildings called data centers. The demand is just off the charts. To build the capacity needed for the next wave of AI, the world is going to have to invest an estimated $6.7 trillion by 2030. These are the new factories of the 21st century, and we are just in the first inning of a historic construction boom.
And here's the thing, it's not even just about the data centers themselves. This is a classic picks and shovels play. During the gold rush, the people who really got rich weren't always the ones finding gold. It was the folks selling them the picks, the shovels, and the blue jeans. Same thing here. For every data center, you need specialized companies for cooling, for networking, for the physical construction, and for the absolutely massive power systems to run the whole thing.
Okay, so we see this huge split happening, winners and losers. But let's get into the why. What's the actual math that makes a simple, boring local grocery store potentially more valuable today than a glamorous downtown office tower?
It all boils down to one critical number: net operating income. You'll hear people call it NOI. It's kind of like a company's EBITDA. Basically, it's the pure cash flow the building spits out from its operations. You take all the rents you collect, you subtract all your daily costs, like maintenance, insurance, taxes, and what you have left is your NOI. It's the most important number in commercial real estate, period.
So how does this magic number tell you what a building is worth? It's actually a pretty simple three-step recipe. Step 1, you figure out your NOI. Step 2, you find the market cap rate. Now just think of the cap rate as the risk score for that building. A risky property like a half-empty office gets a high risk score, a high cap rate. A safe property like a busy grocery store gets a low risk score. Then for step 3, you just divide your income, the NOI, by that risk score, the cap rate. That's it.
And this is where you see the great bifurcation in black and white. Just look at this. On the left, you've got a shopping center with a grocery store. It's 98% full because, people always need milk and eggs. Its income is super stable. Since it's low risk, investors give it a low cap rate, maybe 6%. So it's worth a lot. Now look at the office building on the right. Maybe it's only 65% full. Its income is shaky. It's super high risk, so investors demand a much higher return, a high cap rate. Let's say 10%. And that higher number, it just decimates the final valuation. This simple math is what's creating kings on one side and zombies on the other.
Okay, so let's pull back and look at the big picture here. When you put all these pieces together, what does it really mean? It means the physical world we all live and work in is being fundamentally reshaped right now by these incredibly powerful forces.
So let's just run through the big takeaways here. First, that $1.8 trillion debt wall is the trigger for all of this. Second, the death of the office is not an exaggeration, it's creating these zombie assets that could be lurking in your retirement portfolio. Third, on the flip side, e-commerce and AI are creating a once-in-a-generation boom for logistics and data centers. And finally, the most important point, what we think of as valuable real estate is changing right under our feet. It's shifting away from the shiny skyscrapers and towards the essential, often invisible infrastructure that powers our lives.
And you have to understand, this split we're seeing, this is just the first tremor. The rise of AI isn't just happening on our screens. It's a physical event that's going to have enormous consequences for our power grids, our supply chains, our land. Which really leaves us with one final, massive question to chew on. As AI continues to rewrite our digital reality, what other parts of our physical world are about to be completely and unrecognizably transformed next?